Who really moves prices? In the modern era of finance, we are taught to think of the market as a vast, impersonal force, a complex system driven by macroeconomic data, corporate earnings, and the collective, decentralized wisdom of millions of participants. We look for our answers in algorithms, in economic forecasts, and in sophisticated financial models. But there was a time in the Gilded Age of American capitalism when the answer to that question was far simpler and far more personal. In that era, the price of a stock, and sometimes the fate of the entire market, could be dictated by the will, the capital, and the cunning of a single brilliant and often ruthless man. This is the story of the master of those men, the definitive Wall Street operator of his time. This is a deep dive into the world of James R. Keene. Known as the Silver Fox of Wall Street, he was not an investor in the modern sense. He was a master strategist, a financial general who viewed the market as a battlefield and stocks as instruments in a grand campaign of psychological warfare. His life's work was the perfection of a single powerful weapon, the stock pool. To understand the methods of James R. Keene is to understand the hidden mechanics of price movement, to see the market not as a random walk, but as a carefully orchestrated drama. We will deconstruct his biography, the unregulated arena in which he operated, and the timeless three-act structure of the market manipulations that made him a legend. This is an exploration of the dark art of the market mover. To comprehend the operator, one must first comprehend the man and the experiences that forged his unique and cynical worldview. James R. Keene was not a product of New York financial aristocracy. He was a man shaped by the rough and tumble frontiers of 19th century America. Born in London in 1838, he emigrated to the United States as a teenager and eventually made his way to California during the chaotic years of the gold rush. It was here, in the speculative frenzy of the San Francisco mining exchanges, that he received his first education in the raw, untamed nature of markets. This was an environment driven not by balance sheets and earnings reports, but by rumors of new gold strikes, by brazen promotion, and by the primal human emotions of greed and fear. Keene proved to be a natural. He possessed a sharp analytical mind, a cool demeanor under pressure, and an innate talent for calculating odds. He amassed his first fortune in the mining stocks of the Comstock Lode, becoming one of the wealthiest and most influential men on the West Coast. However, it was his first catastrophic failure that would provide his most valuable lesson. Flush with success, Keene set his sights on a larger prize, the national commodities market. He attempted what was known as the Great Wheat Corner, an audacious plan to corner the entire wheat market of California. But he had underestimated the complexity and the power of the larger players in that arena. The corner failed spectacularly, and Keene was completely wiped out. He lost his entire fortune. This ruinous experience was his trial by fire. It taught him a lesson he would never forget, that individual brilliance without a deep structural understanding of the game and immense capital was not enough. He left California for New York in 1877, nearly broke but armed with a profound and brutally earned education in the mechanics of speculation and the dangers of underestimating the forces aligned against him. It was on Wall Street that he would stage one of the greatest comebacks in financial history, rising to become the most respected and most feared stock pool operator of his generation. He understood, better than anyone, the environment in which he was now operating. The Gilded Age market was an arena almost entirely without rules. There was no Securities and Exchange Commission, no laws against insider trading, and no meaningful disclosure requirements for public companies. The ticker tape, which printed the price and volume of trades, was the primary source of information for the public, and it was a tool that could be easily manipulated. The financial press was, in many cases, corrupt. Journalists and even entire publications were often on the private payroll of large financiers, ready to print bullish or bearish stories to support a market campaign. The game was rigged, and Keene knew it. His strategy was not to lament this fact, but to become the most skilled player of that rigged game. At the center of this world was the stock pool, the primary instrument of market manipulation. A pool was a secret syndicate, a temporary partnership of wealthy financiers who would combine their immense capital for a single purpose: to engineer a massive upward move in a specific stock, and then to sell their shares to the public at the peak of the frenzy they had created. This was not a passive investment strategy. It was an active, aggressive, and highly coordinated campaign. James R. Keene was the acknowledged master of this art form. He was the general that other great financiers, including J.P. Morgan himself, would hire to lead their most important market operations. His success was based on his development of a repeatable three-act structure for these campaigns, a process that revealed a deep understanding of market mechanics and, most importantly, mass psychology. The first act of any successful pool operation, and the one that required the most patience and capital, was Act 1, accumulation. The objective of this phase was simple but immensely difficult: to acquire a massive block of a target stock, often 20 to 50% of the entire publicly available float, without alerting the market and causing the price to rise prematurely. This was a quiet hunt, conducted with the stealth of a predator. Keene would operate through dozens of different brokerage accounts, spreading his buy orders out to disguise the scale of his operation. He would never chase the stock upward. Instead, he would patiently wait for moments of market weakness, for days when the public was fearful and selling, and he would use that selling as an opportunity to absorb their shares. This phase could last for weeks or even months. It required a deep understanding of the stock's behavior, its typical daily volume, and its key support and resistance levels. The goal was to become the dominant but invisible buyer in the market. The pool would absorb every share that came for sale from discouraged investors, from estates that needed to be liquidated, and from weak-handed traders who were shaken out by minor negative news. The psychology of this phase is that it preys on despair. The pool is buying from a public that has given up hope on the stock, that is tired of seeing it go nowhere, and that is eager to sell at any price just to move on. By the end of a successful accumulation phase, the majority of the stock's float had been transferred from the weak, emotional public into the strong, patient hands of the pool operators. The stage was now set for the second and most dramatic act. The second act of the campaign was the markup, the art of public deception. Having quietly accumulated their massive position, the pool's objective now was to create a public frenzy for the stock, to manufacture a wave of intense and irrational buying from the very public from whom they had just bought the shares at a low price. This was a masterclass in psychological manipulation, and Keene employed a full arsenal of tactics to achieve his goal. The first tool was the press campaign. Keene and his allies would begin to plant a series of bullish articles and rumors in the newspapers and financial publications of the day. Suddenly, a previously ignored company would be heralded as having a revolutionary new product, or as being the target of a potential takeover. Experts would be quoted, often paid for their opinion, extolling the company's bright future. This would create the initial narrative, the story that the public needed to justify their future greed. The second and more powerful tool was the direct manipulation of the ticker tape. The public across the country, from the banker in New York to the farmer in Kansas, was mesmerized by the ticker tape. It was their window into the market. Keene knew this, and he played it like an instrument. The pool would begin to engage in wash sales and matched orders, a process of trading large blocks of stock amongst themselves. A pool member would sell 10,000 shares, and another member across the street would simultaneously buy that same block. No shares actually changed hands outside the pool, but on the ticker tape, it would print as a massive transaction. When the public saw their sleepy stock suddenly trading on huge, explosive volume, it created an immediate and powerful sense of excitement. It was a signal that something was happening. This illusion of heavy volume was designed to attract the attention of every tape reader and speculator in the country. The third tool was the tipster network. The bullish tips originating from the pool would be spread through the network of brokerage houses, whispered to clients as inside information. This created an aura of exclusivity and urgency. The average person, believing they were being let in on a secret known only to the insiders, would rush to buy. The final tool was the price action itself. Keene would use the pool's immense capital to engineer a clean, obvious breakout from the stock's long accumulation base. This was designed to attract the technical traders, the followers of chart patterns who would see the breakout as a clear buy signal. The combination of these four tactics, a bullish narrative, the illusion of high volume, the allure of inside information, and a powerful chart pattern, was almost irresistible. The psychology of this phase preys on greed and the fear of missing out. The public, seeing a stock rising on high volume with a great story, feels a powerful, almost primal compulsion to get on board before the train leaves the station. The tactics of the Gilded Age pools were blatant and unregulated. In today's highly regulated, high-speed market, the game is different. Or is it? Do you believe similar forms of large-scale manipulation still exist, just in a different, more sophisticated form, perhaps through coordinated hedge fund activity or social media campaigns? Share your view in the comments. The final act of the campaign was the distribution, the silent exit. This was the most delicate and skillful part of the entire operation. Having created a public frenzy, the pool's objective was now to sell its entire massive holding to the euphoric public at the highest possible prices without crashing the market. As the wave of public buying reached a fever pitch, the pool would carefully and methodically begin to feed its shares into the market. They would sell into the rallies, absorbing the public's buying power. If the buying started to wane and the price began to sag, the pool would step back in with a few large buy orders to support the price, creating the illusion of continued strength and luring in one final wave of hopeful amateurs. The psychology of this phase preys on euphoria. The pool is selling to buyers who are no longer operating on logic but are convinced that the stock is destined for the moon. The pool operators, the ultimate realists, are the only ones in the market who know the true story, that the entire move was an engineered fiction. Once the last of their shares had been sold, the pool would quietly withdraw its support from the market. Without their artificial buying to prop it up, the stock's price would inevitably collapse under its own weight, leaving the public who had bought at the top with devastating losses. This three-act drama, from the quiet accumulation in the depths of despair, to the loud orchestrated markup built on greed, to the final silent distribution at the peak of euphoria, was the blueprint that James R. Keene perfected. It is a timeless model of how the few can systematically exploit the predictable, emotional behavior of the many. Having deconstructed the theoretical blueprint of a classic Gilded Age stock pool, the primary weapon of James R. Keene, we now turn to the master artist at work. A framework is merely an intellectual exercise until it is tested in the crucible of a real-world market campaign, with millions of dollars and professional reputations on the line. In this section, we will analyze how these principles of accumulation, markup, and distribution were applied with tactical genius in one of Keene's most significant and challenging operations. We will then explore what Jesse Livermore, the greatest speculator of the next generation, learned from observing the silver fox in action. Finally, we will ask the most important question: does this game of manipulation and engineered sentiment still happen today? The answers reveal the timeless nature of the forces that truly move prices. The ultimate case study of James R. Keene's methodology in action was not a small speculative campaign in an obscure stock, but an operation of national importance conducted at the personal request of the most powerful financier in the world, J.P. Morgan. The context was the creation of U.S. Steel in 1901. As we have discussed in a previous analysis, this was the largest corporate consolidation in history up to that point, a $1.5 billion behemoth that represented the pinnacle of Morgan's philosophy of order and control. However, the sheer scale of the new corporation created a problem. The stock was heavily watered, meaning its market capitalization far exceeded the tangible asset value of the merged companies. From the moment it began trading, the new security came under immense selling pressure. European investors, skeptical of this new American giant, began to dump their shares. Arbitrageurs who had participated in the complex merger were selling to lock in their profits. The stock, which Morgan needed to be a symbol of industrial strength and stability, began to falter, threatening the success of his entire grand project and the stability of the broader market. J.P. Morgan, a master of organization but not a stock market operator, knew he needed the best in the business to manage the situation. He summoned James R. Keene. Morgan's objective for Keene was not to engineer a speculative bubble, but to create a stable, orderly, and liquid market for U.S. steel stock. He needed to absorb the immense selling pressure and build confidence among the American investing public. Keene was given command of a massive syndicate, a pool with a war chest of millions of dollars. His subsequent campaign was a masterclass in market management, a perfect illustration of the three-act structure, but adapted for a different purpose. Act 1 of this campaign was not quiet accumulation, but loud and visible stabilization. Keene's first task was to halt the decline and establish a floor under the price. He and his syndicate entered the market as powerful, conspicuous buyers. They absorbed the relentless selling coming from Europe day after day, week after week. This was a battle of titans. On one side was the skeptical global investment community. On the other was the immense capital and unshakable will of the Morgan Keene syndicate. By consistently buying at key price levels, Keene sent a clear signal to the market. This stock would not be allowed to collapse. He was drawing a line in the sand, creating a psychological support level that was backed by the most powerful financial interests in the country. This initial phase was a brutal war of attrition, requiring immense capital and steady nerves. But it was essential for draining the initial powerful wave of selling pressure. Act 2 was the markup, but in this case it was a campaign of confidence building. Instead of spreading wild, unsubstantiated rumors, Keene's task was to make the public believe in the legitimate long-term fundamental value of U.S. steel. He used his mastery of the ticker tape to achieve this. He would skillfully trade the stock, creating an appearance of orderly, natural strength. The price would advance steadily, with healthy volume, and then experience shallow, low-volume pullbacks. This was the picture of a healthy, institutionally supported stock. Simultaneously, the press, heavily influenced by the Morgan interests, began to publish a steady stream of positive articles about U.S. Steel's dominant market position, its production capacity, and its importance to the American economy. Keene was not creating a fiction. He was skillfully curating the narrative, focusing the public's attention on the company's strengths while his syndicate's buying provided a stable price foundation. Act 3, the distribution, was the final and most delicate phase. After months of stabilization and confidence building, a natural and self-sustaining public market for the stock had finally developed. Investors, now convinced of the company's viability, were willing and eager buyers. At this point, Keene's job was to methodically and silently liquidate the massive position that his syndicate had accumulated. He had to sell millions of shares without disrupting the very market confidence he had worked so hard to create. He would sell into the rallies, feeding the public's demand, and then support the stock on the dips to maintain stability. Over a period of more than a year, he successfully unwound the entire position, not only stabilizing the stock and ensuring the success of Morgan's great consolidation, but also earning a substantial profit for the syndicate members. The U.S. Steel campaign was Keene at the peak of his powers, demonstrating that the same principles used to engineer a speculative bubble could also be used to create market stability, all while showcasing his unparalleled skill as a large-scale operator. This level of operational genius was not lost on the next generation of great speculators. The man who is often considered the greatest of them all, Jesse Livermore, was a profound student of James R. Keene's methods. In the pages of Edwin Lefebvre's classic Reminiscences of a Stock Operator, Livermore's fictional counterpart expresses a deep and genuine admiration for the silver fox. This was not the respect of a student for a teacher, but of one master operator for another. Livermore saw in Keene a mind that operated on the same wavelength as his own, a man who understood the deep, unchanging truths of the market. Livermore did not admire Keene for his ability to manipulate, but for his profound understanding of market psychology and timing. He saw that Keene's success was not just a function of his immense capital, but of his almost supernatural ability to read the public mind. He knew exactly when the public was at its most fearful and pessimistic, the perfect time to accumulate. He knew exactly how to craft a narrative and paint a picture on the tape that would ignite their greed. And most importantly, he knew, with uncanny precision, when the public's buying power had reached its peak, the perfect moment to begin his distribution. Livermore, who spent his own life battling the emotional impulses of the crowd, recognized Keene as the ultimate master of this psychological game. He respected Keene's courage to take on immense positions and to stand against the prevailing trend when his analysis told him it was time. He saw Keene not as a simple manipulator, but as a brilliant strategist who played the game of human emotion with the skill of a grandmaster. Livermore's own campaigns, though typically conducted alone rather than with a syndicate, were often a solo performance of the same three-act drama that Keene had perfected: quiet accumulation, a carefully timed markup, and a silent distribution at the top. This brings us to the most critical question. Do these methods, this entire worldview, have any relevance today? The world of James R. Keene, a world without regulation where a single man could corner a market and manipulate the press at will, seems like a distant, almost mythical past. But while the tools and the rules of the game have changed, the fundamental driver that Keene exploited, human psychology, has not. The same forces of fear, greed, and herd behavior that he manipulated are still the primary drivers of speculative bubbles and crashes in the 21st century. The pools of the Gilded Age may be gone, but their echoes are all around us. Consider the modern phenomenon of hedge fund wolf packs. These are groups of activist or event-driven hedge funds that, while not formally colluding in a single syndicate, often share ideas and take similar concentrated positions in a target company. Through their public letters, their media appearances, and their collective buying or selling pressure, they can create a powerful narrative that moves a stock's price and forces a desired outcome such as a merger or a change in management. This is a modern, more sophisticated form of a pool operation, using regulatory filings and media campaigns as its primary weapons. An even more direct and chaotic parallel can be found in the world of social media and meme stocks. The GameStop saga of 2021 was a perfect, if disorganized, modern-day reenactment of a Keene-style market campaign. The accumulation phase was the initial deep value analysis posted on forums like Reddit's Wall Street Bets, where a small group of users identified the stock's massive short interest. The markup phase was one of the most explosive in history, a decentralized and viral campaign that used memes, social media influencers, and a powerful us versus them narrative to create a global buying frenzy. The distribution phase was the inevitable, chaotic, and often painful collapse as the early participants took profits and the public, who had bought at the peak of the euphoria, was left with immense losses. The tools were different: memes instead of newspaper articles, Reddit instead of a secret syndicate. But the underlying psychological drama was identical to what Keene was orchestrating over a century ago. The finfluencers on platforms like Twitter and TikTok have, in many ways, become the modern equivalent of the paid journalists of Keene's era, capable of moving markets and creating speculative manias with a single, compelling narrative. The ultimate lesson from the world of James R. Keene is that the answer to the question, who really moves prices, is and has always been the most organized, best capitalized, and most psychologically astute operators. In his day, that was a single man and his secret syndicate. Today, it may be a group of hedge funds or a decentralized digital crowd, but the principle remains the same. Prices are moved not just by abstract fundamentals, but by powerful interests who understand how to create and exploit a compelling narrative that taps into the timeless and predictable emotions of the human herd. Before we conclude, we want to extend our gratitude to you, our viewers. We put an immense amount of research and effort into creating these deep dives, and your engagement is what makes it all possible. To everyone who watches, who subscribes, and who takes the time to leave a thoughtful comment, thank you. Your participation is what helps these videos reach a wider audience on YouTube. A special thanks is due to those of you who have supported the channel through the Super Thanks feature. Your direct support is a powerful motivator for us to continue this work and to keep raising the bar on the quality of our analysis. In conclusion, the legacy of James R. Keene is a complex and often uncomfortable one. He was a master of a game that is now illegal, a strategist who operated in the gray areas of a market without a conscience. But to dismiss him as a mere manipulator is to miss the profound and timeless lessons of his career. He was a supreme market psychologist, a man who understood with perfect clarity that stock prices are not a reflection of numbers on a page, but of the hopes and fears in the hearts of men. He showed that the greatest market moves are not random events, but are often the result of deliberate, orchestrated campaigns. His life's work is a crucial reminder that to truly understand the market, one must look beyond the ticker tape and ask the most important question: who is on the other side of the trade, and what is their true intention? As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.